The power of investing. Why choose mutual funds? Investing is crucial for building wealth. It's not just about putting money aside, it's about making your money work for you. It helps you stay ahead of inflation and achieve your financial goals. Whether you're saving for a down payment on a house, planning for your children's education, or securing a comfortable retirement, investing is key. But for many, the world of investing can seem daunting. The sheer number of options and the complexity of financial markets can be overwhelming. That's where mutual funds come in. They simplify the process, making it easier for everyone to invest. They offer a simple and effective way to participate in the stock market without needing to be a financial expert. You don't need to spend hours researching individual stocks or bonds. Mutual funds pool money from various investors and invest it in a diversified portfolio of assets like stocks and bonds. This means your investment is spread across many different securities. This diversification spreads your risk, offering a safety net compared to investing in individual stocks. Instead of putting all your eggs in one basket, mutual funds allow you to spread your investment across multiple assets. Mutual funds are managed by professional fund managers who use their expertise to make investment decisions on your behalf. These managers analyze market trends, economic data, and company performance to make informed choices. Mutual funds are an excellent option for both seasoned investors and beginners. They provide a way to invest without needing extensive knowledge or experience. They require a relatively low initial investment, making them accessible to a wider range of individuals. You don't need a large sum of money to get started. With a mutual fund, you become a part owner of all the securities within the fund's portfolio. This means you benefit from the performance of a wide range of investments, all managed by professionals. Understanding the basics. What is a mutual fund? A mutual fund is a type of investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Let's break down what a mutual fund is. It's essentially a collective investment scheme that allows individual investors to access a diversified portfolio without needing to buy each security individually. Imagine a large basket filled with different stocks and bonds. This basket represents the mutual fund's portfolio, which is a mix of various financial instruments. When you invest in a mutual fund, you're essentially buying a piece of this basket. Your money is pooled together with that of other investors, giving you a share in the overall portfolio. This basket is managed by a fund manager whose job is to pick the right stocks and bonds to put in the basket and when to buy or sell them. The fund manager uses their expertise to make investment decisions aimed at achieving the fund's objectives. Each mutual fund has a specific investment objective, such as growth, income, or a balance of both. These objectives guide the fund manager's decisions and help investors choose the right fund for their needs. This objective is clearly stated in the fund's prospectus, a document that provides detailed information about the fund's strategy, fees, and risks. The prospectus is essential reading for any potential investor. By understanding the fund's objective, you can choose one that aligns with your own financial goals. Whether you're saving for retirement, a child's education, or another long-term goal, there's likely a mutual fund that fits your needs. For example, if you're aiming for long-term growth, you might choose a fund that invests primarily in stocks. These funds typically have higher risk, but also the potential for higher returns over time. If you're looking for regular income, you might opt for a fund that focuses on bonds or dividend-paying stocks. These funds tend to be less volatile and provide a steady stream of income. The beauty of mutual funds is that they cater to a wide spectrum of risk appetites and investment horizons. Whether you're a conservative investor looking for stability or an aggressive investor seeking high returns, there's a mutual fund designed to meet your needs. Additionally, mutual funds offer professional management, diversification, and liquidity, making them an attractive option for many investors. They provide an easy way to invest in a diversified portfolio without the need to manage individual investments. It's important to review the performance of your mutual fund regularly and make adjustments as needed. Staying informed and proactive can help you achieve your financial goals more effectively. In summary, mutual funds are a versatile and accessible investment option that can help you build wealth and achieve your financial objectives. By understanding how they work and choosing the right fund for your needs, you can make informed investment decisions. The lock-in dilemma: flexibility versus commitment. Traditionally, many mutual funds came with a lock-in period. This meant that your money was locked in for a certain duration, typically ranging from a few months to several years. During this period, you couldn't withdraw your investment without incurring a penalty. While lock-in periods were designed to encourage long-term investment discipline, they came with a significant drawback: limited flexibility. Life is unpredictable, and financial emergencies can arise unexpectedly. Having your money locked in during such times can be a major inconvenience. This is where mutual funds without a locking period emerge as a game changer. They offer the best of both worlds: the potential for investment growth and the freedom to access your funds when you need them most. Breaking free: the allure of mutual funds without locking periods. Imagine having the freedom to withdraw your investments at any time without being penalized. That's precisely what mutual funds without a locking period offer. This flexibility is particularly beneficial for investors who prioritize liquidity and want easy access to their funds. These funds are also an excellent option for individuals with shorter investment horizons or those who are unsure about their long-term financial commitments. For instance, if you are saving for a down payment on a house or your child's education in a few years, a no-lock-in mutual fund can be an ideal investment vehicle. Furthermore, the absence of a lock-in period doesn't necessarily mean compromising on returns. Many no-lock-in funds have a proven track record of delivering competitive returns over the long term. Section 5. Open-ended funds. Your gateway to liquidity and growth. These funds are designed to offer investors a flexible and accessible way to invest in the stock market. Let's delve into the different types of mutual funds that typically don't have locking periods. These funds are ideal for those who want the freedom to enter and exit their investments without any restrictions. Open-ended funds are the most common type of mutual fund. They are popular because they offer a high degree of liquidity and flexibility, making them a preferred choice for many investors. They allow investors to buy and sell units of the fund at the net asset value, or NAV, on any business day. This means you can react quickly to market changes and adjust your investment strategy as needed. The NAV is calculated at the end of each trading day based on the market value of the fund's underlying securities. This ensures that the value of your investment is always up to date and reflective of current market conditions. Open-ended funds offer immense liquidity, meaning you can easily buy or sell your units without having to wait for a specific lock-in period to end. This is particularly beneficial for investors who need quick access to their funds. This flexibility makes them suitable for both short-term and long-term investment goals. Whether you're looking to make a quick profit or build your wealth over time, open-ended funds can accommodate your needs. Whether you're a seasoned investor or just starting, open-ended funds provide a user-friendly way to participate in the stock market and potentially grow your wealth. They offer a balanced approach to investing, combining the potential for high returns with the convenience of easy access to your money. Section 6. Liquid funds. Parking your money smartly. Liquid funds are a type of debt mutual fund that invests in short-term debt instruments like treasury bills, commercial paper, and certificates of deposit. These funds are known for their low risk and high liquidity. They aim to provide investors with moderate returns while ensuring the safety of their principal. Liquid funds are an excellent option for parking your emergency funds or any surplus money that you might need in the short term. Unlike traditional savings accounts, which typically offer low interest rates, liquid funds have the potential to generate higher returns. They are also more tax efficient than traditional fixed deposits for investors in specific tax brackets. Section 7. Ultra-short duration funds. Balancing risk and reward. Ultra-short duration funds are another category of debt mutual funds that fall under the no lock-in umbrella. These funds invest in debt securities with maturities typically ranging from 3 to 6 months. They offer a slightly higher return potential compared to liquid funds, but come with marginally higher risk. Ultra-short duration funds are suitable for investors who are looking for a balance between liquidity and returns. They are a good option for parking funds for a period of a few months to a year. These funds are ideal for investors who want to earn slightly higher returns than traditional savings accounts, but are not comfortable taking on the risk associated with longer-term debt funds. Section 8. Index funds, riding the market wave. Index funds are a type of mutual fund that passively tracks a specific market index, such as the S&P 500 or the Nifty 50. Instead of trying to beat the market, index funds aim to replicate the performance of the chosen index. They are known for their low fees and tax efficiency. Index funds are a great option for investors who believe in the long-term growth potential of the market and want a hassle-free investment approach. They are particularly suitable for beginners who are new to the world of investing and want to avoid the complexities of actively managed funds.